A billion-dollar bet. Robinhood's bold move. Robinhood, the financial technology company that brought Wall Street to Main Street, just made a billion-dollar bet on itself. Not on a hot new stock, not on a cryptocurrency flying high, but on its own shares. That's right, Robinhood is buying back its own stock. A move that has sent ripples through the financial world and left investors buzzing. This isn't just another fintech company flush with cash, looking for a place to park it. This buyback is a statement, a power play in the high-stakes game of finance. It's a signal to the market, to competitors, and most importantly, to Robinhood's own investors. But what does it all mean? Why would a company, especially a fintech company known for innovation and disruption, choose to buy back its own shares? And what does this billion-dollar gamble say about Robinhood's future? Hold on tight, because we're about to break down Robinhood's billion-dollar bet, exploring the ins and outs of stock buybacks, their impact on investors, and what this strategic move could mean for the future of this financial maverick. To the buyback basics, understanding the game. Before we dive into Robinhood's specific play, understanding the game is crucial to grasping the implications of this move. Imagine a company as a pie. Each share of stock represents a slice of that pie. When a company buys back its own shares, it's essentially taking slices off the table, reducing the number of slices available. Fewer slices mean bigger portions for everyone else. That's the basic idea behind stock buybacks. By reducing the number of shares outstanding, each remaining share represents a larger ownership stake in the company. This can lead to a boost in the stock's price, benefiting shareholders. But it's not just about making the pie smaller. Buybacks are often seen as a sign of confidence. When a company believes its stock is undervalued, meaning the market isn't fully recognizing its worth, a buyback is a way of putting its money where its mouth is. It's like saying, "We think our stock is a steal at this price, so we're buying it ourselves." Of course, like any financial maneuver, buybacks have their critics. Some argue that companies should be using their cash to invest in growth opportunities, research and development, or even employee benefits, rather than enriching shareholders. 3. Robinhood's playbook, deciphering the strategy. So back to Robinhood. Deciphering the strategy behind Robinhood's decision reveals why this tech-savvy brokerage is diving headfirst into the world of buybacks. The company has been facing some headwinds, including regulatory scrutiny, increased competition, and a slowdown in trading activity. This has put pressure on its stock price, which has been trading well below its initial public offering, IPO, price. Enter the $1 billion buyback. This move can be seen as a way for Robinhood to signal confidence in its own future. By buying back its shares, the company is essentially saying, "We believe in our long-term prospects, and we think our stock is currently undervalued." The timing of the buyback is also significant. It comes after a period of volatility in the stock market, which may have created an opportunity for Robinhood to buy back its shares at a more favorable price. This move could potentially help to stabilize the stock price and boost investor confidence. But it's not just about optics. The buyback also has tangible financial implications. By reducing the number of shares outstanding, Robinhood is increasing its earnings per share, EPS, a key metric used by investors to evaluate a company's profitability. 4. The share shuffle, immediate impacts and reactions. The market reacted to Robinhood's buyback announcement with cautious optimism. The stock price saw an initial jump, a knee-jerk reaction to the news. Investors often interpret buybacks as a positive sign, indicating that the company believes its stock is undervalued. However, this initial bump doesn't tell the whole story. The real impact of a buyback unfolds over time. The reduced share count gradually impacts earnings per share, potentially leading to higher dividends for investors down the line. It's important to note that buybacks aren't a magic bullet. They don't automatically guarantee a surge in stock price or solve underlying business challenges. Robinhood still faces the same competitive landscape and regulatory pressures. The success of this buyback hinges on Robinhood's ability to navigate these challenges, attract new users, and continue to innovate in the rapidly evolving world of finance. 5. The value proposition, buybacks, and shareholder wealth. Now let's talk about you, the investor. What does this buyback mean for your slice of the Robinhood pie? On the surface, a buyback can increase the value of your shares. With fewer shares in circulation, each share represents a larger piece of the company, potentially leading to a higher price per share. Think of it like this. You own a piece of land, and suddenly, the neighboring plot is bought up and merged with yours. Your property just became more valuable because you now own a larger portion of the land. However, the long-term impact on shareholder value is more nuanced. While buybacks can boost share prices in the short term, they don't address the fundamental factors driving a company's growth and profitability. Investors should view buybacks as one piece of the puzzle, not the whole picture. It's crucial to assess the company's overall financial health, its growth strategy, and its ability to generate long-term value for shareholders. Buybacks and shareholder wealth are closely linked, but understanding the broader context is key. 6. Beyond the bottom line. Is this a long-term vision or a short-term tactic? Robinhood's buyback has sparked debate about the company's priorities. Is this a strategic move to unlock shareholder value and signal confidence in its future? Or is it a short-term tactic to appease investors and inflate the stock price, especially after a period of decline? The answer, like most things in finance, is complex. On one hand, the buyback demonstrates Robinhood's belief in its own potential. It suggests that the company sees its current valuation as a buying opportunity, a chance to increase ownership, and by extension, shareholder value. On the other hand, critics argue that Robinhood could be using this capital for more impactful initiatives. Investing in product development, expanding into new markets, or enhancing user experience could potentially yield greater long-term returns compared to a stock buyback. The debate highlights the delicate balance companies face between returning value to shareholders and investing in future growth. 7. Robinhood's balancing act, growth versus returns. Robinhood's buyback shines a light on a fundamental tension in the corporate world, the balance between reinvesting profits for growth and returning value to shareholders. Companies constantly grapple with this dilemma, weighing the potential rewards of expansion against the immediate benefits of rewarding investors. Growth-oriented companies, particularly in the tech sector, often prioritize reinvesting profits back into the business. They pour money into research and development, talent acquisition, and marketing, aiming to capture a larger market share and establish a dominant position. On the other hand, mature companies with established market presence might prioritize returning value to shareholders. This can take the form of dividends, share buybacks, or other initiatives aimed at directly benefiting investors. Robinhood, despite its relatively young age as a public company, is already navigating this balancing act. The buyback suggests a shift towards shareholder value, a move that might appease some investors while raising eyebrows among those who see greater potential in aggressive growth. 8. The competitive landscape buybacks in the tech world. Stock buybacks aren't unique to Robinhood. In fact, they've become increasingly common in the tech industry, particularly among giants like Apple, Microsoft, and Alphabet, Google's parent company. These behemoths often sit on mountains of cash, and buybacks offer a way to return some of that wealth to shareholders. However, Robinhood's situation differs significantly from these established players. As a younger company operating in a fiercely competitive landscape, Robinhood faces pressure to innovate, expand its user base, and fend off rivals. Allocating $1 billion to buybacks, while potentially boosting shareholder value, could limit its ability to invest in these crucial areas. The buyback also raises questions about Robinhood's long-term vision. Is the company prioritizing short-term gains and appeasing investors? Or is this part of a larger strategy to consolidate its position and prepare for future growth? Buybacks in the tech world have unique implications, shaping the strategic direction and financial health of companies in this dynamic sector. Now for the future of Robinhood. Charting the course ahead. Charting the course ahead for Robinhood involves a billion-dollar buyback, a calculated risk aimed at bolstering its stock price, signaling confidence, and potentially rewarding shareholders. Whether this move pays off in the long run remains to be seen. The company's success hinges on its ability to navigate a rapidly evolving financial landscape, marked by intense competition, regulatory scrutiny, and ever-changing investor expectations. Robinhood must continue to innovate, attract and retain users, and demonstrate its ability to generate long-term value. The buyback is merely one chapter in Robinhood's story, a story that's still being written. Only time will tell if this gamble will pay off, propelling Robinhood to new heights, or whether it will be remembered as a costly misstep in the high-stakes game of finance. Please subscribe to our channel and click the notification bell to stay updated with our latest content.